The global economy produces $105 trillion in GDP every year. $32 trillion of private wealth exists completely outside that accounting, untaxed, untracked, structurally invisible. The question is not where it's hidden. The question is what architecture makes that concealment not just possible, but permanent. This is not about rogue oligarchs or offshore accounts opened in the dark. The last time you paid income tax, the people above you in the capital structure had already converted theirs into something that never becomes taxable income at all. What you are about to see is a blueprint, built over decades, refined by institutional lawyers, and invisible to the systems designed to regulate it. It does not operate despite global financial law. It operates through it, and there is one structural mechanism at the center of it that makes the entire architecture self-perpetuating. But we are not there yet. Start with what everyone gets wrong. Offshore wealth is not stored offshore. The image, the numbered Swiss account, the Cayman shell, is 20 years obsolete. Modern wealth concealment operates through layered legal entities, trusts, foundations, holding companies, nested inside one another across multiple jurisdictions. Each layer adds 1 degree of legal separation between the asset and its owner. A Delaware LLC holds shares in a Cayman fund, which holds a stake in a Luxembourg SICAV, which holds real assets in London and Singapore. At every node, a different legal system applies. No single regulator sees the full chain. The structure is not illegal. That is precisely the point. It is the product of legal engineering applied at institutional scale. The Pandora Papers and Panama Papers gave the public a partial view, a few thousand names from a dataset of millions. But leaks expose individuals. They do not expose architecture. The logic that makes $32 trillion structurally invisible was never in the papers. It lives in 5 jurisdictions, which together hold more concealed capital than the next 40 combined. Most analysts know 3 of them. The 4th and 5th are where the structure becomes permanent. First, the Cayman Islands, not a bank, a fund domicile. Over 70% of global hedge funds are legally registered there, not because the money lives there, but because the legal entity does. Second, Luxembourg, the silent capital of European institutional leverage. Population, 650,000. Assets under management, over $5 trillion, more than Germany. Third, Delaware, near total ownership opacity, inside a G7 nation, with full legal legitimacy. More registered corporate entities exist in Delaware than people living in it. The 4th and 5th jurisdictions come later, because before we get there, you need to understand the single instrument that makes all of this not just functional, but generational. The most powerful wealth preservation tool in existence is not a fund. It is not a bank account. It is a dynasty trust. A dynasty trust holds assets across multiple generations. In some jurisdictions, without any terminal date, assets inside never trigger an estate transfer event. They are never technically inherited. They are administered. No estate tax, no inheritance tax, no capital gains event, ever. The Rockefeller family has operated inside trust structures continuously since the 1930s. The capital has compounded. The tax burden has not. The assets you will one day pass to the next generation face estate tax rates of up to 40%. The structures in this analysis face 0. Across 3 generations, that asymmetry produces an outcome that has no parallel in ordinary wealth accumulation. None. The most important American jurisdiction for this architecture is not New York. It is not California. It is South Dakota. South Dakota operates with no rule against perpetuities. That phrase means the trust can last forever. South Dakota now holds over $600 billion in trust assets. 15 years ago, that number was under $100 billion. That is the 4th jurisdiction. The 5th is the one that surprises every analyst who reaches this point: Singapore. No capital gains tax, no inheritance tax. Full treaty access to Asian capital markets simultaneously. Singapore's registered family office sector grew from approximately 50 entities in 2010 to over 1,500 today, absorbing Asian billionaire capital and European old money, rotating out of Swiss structures under regulatory pressure. 5 nodes: Cayman, Luxembourg, Delaware, South Dakota, Singapore. Capital moves between them not randomly, but according to specific preservation and leverage objectives. A single family office might incorporate the operating company in Delaware, book profits through Luxembourg, hold the dynasty trust in South Dakota, and custody liquid assets in Singapore. Most analyses stop here. That is the first mistake. Because the structure is only the container, what drives the compounding is the borrowing architecture running inside it. Ultra-high net worth families do not sell assets to fund consumption, they borrow against them. This is called securities-based lending, and it converts unrealized appreciation into deployable liquidity without a single taxable event. A billionaire holds $2 billion in appreciated stock. They borrow $500 million against it at 2.5%. The loan is not income. No gain is realized, no tax is owed. The borrowed capital is deployed into real assets, private equity, or additional leverage positions. That is the first layer of the borrowing architecture. The second layer is where it becomes structural dominance. The same trust holding the assets is pledged as collateral for a private credit facility. A family trust pledges its holdings, private equity stakes, real property, art, precious metals, to a private bank. The private bank extends a credit line. The family deploys that credit line into new investments, which compound tax-free inside the trust. A closed loop of leverage and preservation, feeding itself across generations. Private banks, Julius Baer, Pictet, Lombard Odier, and the private arms of UBS, exist precisely to service this architecture. Their minimum entry thresholds, $5 million to $25 million, are not marketing decisions. They are structural filters. Below the threshold, you receive a product. Above it, you receive a structure. That distinction defines everything. Now we reach the constraint most people expect to be regulatory. It is not. The architecture is documented. It appears in legal journals, academic tax literature, and institutional advisory white papers. The knowledge is not protected. The barrier is the cost of assembly, and something deeper than cost. Establishing a properly structured dynasty trust with multi-jurisdictional holding entities costs between $500,000 and $2 million in legal, administrative, and compliance fees before a single asset is placed inside. Annual maintenance $150,000 to $600,000, depending on jurisdictional complexity. But that is not the deeper barrier. The deeper barrier is relational. Private banking at the structural level operates on referral, not application. You do not apply for a private credit facility against your trust. You are introduced. The social infrastructure, the family offices, the estate planners, the Swiss lawyers, the institutional advisors, is itself a moat. It took generations to build. It cannot be purchased directly. It can only be inherited or married into. This is why new wealth, even at the $100 million level, remains structurally disadvantaged relative to capital that has been inside the architecture for decades. Every index fund you hold is generating returns for institutional capital that is simultaneously being leveraged, sheltered, and compounded inside structures you do not have access to. The market is the same. The structure is not. Beyond jurisdiction and leverage, there is a third layer, the one that completes the preservation blueprint and closes every remaining tax exposure. Art held inside a trust in a free port, Geneva, Singapore, Luxembourg, is never imported into any taxable jurisdiction. It can be sold, fractionally transferred, or pledged as collateral, without triggering customs or capital gains. The Geneva Freeport alone holds an estimated $100 billion in art, gold, and cultural assets, all in permanent suspension outside any taxable event. A vault with no customs border, a market with no reporting obligation. Structured correctly, an ultra-high net worth family can live entirely on borrowed capital, hold assets across multiple untaxed jurisdictions, and never produce a single reportable income event. The tax obligations that define your financial life simply do not exist at the structural tier above you. This is the architecture in full, and it produces three principles that apply to capital allocation at any scale. First, the structure must precede the capital. Institutional old money builds the container before placing anything inside it. Most people do the opposite and pay the structural cost of that sequencing for the rest of their lives. Second, leverage is not risk at the institutional tier. It is the primary tool of preservation and compounding. The third principle is the one most financial advisors fail to name, even sophisticated ones. But to reach it, one mechanism must be named first. It is called jurisdiction arbitrage. Every major transaction, a business sale, a real estate acquisition, an equity stake, is routed through the jurisdiction that imposes the lowest structural cost at that specific moment. This is not a one-time decision. It is ongoing structural management, executed by a permanent team of specialists whose entire function is friction elimination. Family offices at the $500 million tier and above maintain active relationships with law firms in at least 4 separate jurisdictions simultaneously. The legal cost of running a dynasty family office is typically offset entirely by the first year of tax savings it generates. The structure pays for itself and then compounds indefinitely, which returns us to the $32 trillion figure. That estimate, from economists Gabriel Zucman and Thomas Piketty, is a floor, not a ceiling. The methodology tracks financial assets cross-referenced across jurisdictions. It does not capture art, private equity, physical real estate held in trust, or commodities stored in free ports. The real number is likely between $40 trillion and $50 trillion, approximately 40% of global GDP sitting in a structurally invisible parallel financial system operating in full legal compliance. It is not a shadow economy. It is the real economy, the one the public economy orbits. Governments have intervened repeatedly. FATCA, the Common Reporting Standard, beneficial ownership registers across Europe. Each intervention produced one consistent result. The architecture adapted, new jurisdictions emerged, and the capital repositioned faster than the regulation could follow. South Dakota's trust law expansion came directly in response to FATCA pressure on Swiss banking secrecy. Singapore's Family Office Incentive Program launched the year after European beneficial ownership registers were mandated. The architecture does not resist regulation. It anticipates it and reconfigures before the regulation takes effect. And the newest adaptation involves a layer that existing regulation cannot yet categorize. Tokenized real-world assets, private equity stakes, real estate, commodities, held inside trust structures in jurisdictions with no digital asset reporting framework. The structural invisibility is being rebuilt in digital form, and it is moving faster than any legal framework that would constrain it. The blueprint is not static. It evolves. But the underlying principle never changes. Capital must be structurally separated from obligation. Obligation, tax, inheritance, regulatory reporting, is what erodes accumulated wealth for anyone operating outside the architecture. Inside it, obligation is rerouted, deferred, or legally extinguished, not through avoidance, but through structural design that precedes the obligation entirely. Every financial decision you make, where to incorporate, where to hold assets, when to trigger a gain, carries a structural cost that the architecture above you has already eliminated. That is not an accident, it is the design. The container determines the outcome, not the asset. Two identical assets, same return, same duration, same underlying risk, will produce fundamentally different outcomes depending purely on which structural container holds them. This is the central principle of institutional wealth management. It is almost never communicated outside the private client tier. The structure is the strategy. Everything else is execution. Which returns us to the question embedded at the start of this analysis. What makes $32 trillion in private wealth not just hidden, but permanently, structurally hidden across every reform cycle? The answer is that the architecture was not built to survive regulation. It was built to outlast it. Regulation operates on a 4 to 7 year legislative cycle. The trust structures running today were designed on a generational timeline. The architects of these systems are not reacting to law, they are writing it through lobbying, advisory relationships, and direct participation in regulatory drafting. The revolving door between private banking, family office advisory, and regulatory bodies is not a corruption problem. It is a structural feature. The system regulates itself because the people designing the regulation are the same people servicing the architecture. This is not a conspiracy. It is an alignment of institutional incentives operating across generations, and it produces one outcome with perfect consistency: preservation of capital at the top, erosion of capital at the base. The $32 trillion will not be redistributed. It will not be taxed into relevance. It will compound. Dynasty trusts have no expiration. Jurisdiction arbitrage has no ceiling. Leverage inside a preserved structure has no natural endpoint. The architecture is permanent because it was never designed to be temporary. Wealth is not accumulated. It is engineered.